Bollinger Bands were created not so long ago by John Bollinger, but they were created for the stock market because they were created in the 1970s, before there was online trading, before there was a Forex market, before there was a commodity. Now, Forex and commodities were around, but again, they were traded very slowly. In those days, the only things that traded Forex or currency were the central banks. Because you needed currency in one value or another, you had to go to the bank, and the bank would, if you needed to pay somebody, if you were in the US and you needed to pay somebody in Japan, you go to your bank with your, who held your US dollars, and your bank would have a wire transfer room and a currency room, and you would just give them instructions and they would do it. And it would take a couple of days, but it would go from your bank to the national bank to the central bank, who then would send it to Japan and wire it across. That's all gone with computers and the internet. Okay. Now, it wasn't until years later that people realized they could speculate in currency and make profit. Now, the commodities market's always been primarily packed full of speculators, because you could always buy, because the commodities market is all about speculation. The commodities market started when farmers needed to offset or secure a guaranteed price for their crops because they couldn't play from day to day or season to season. But Bollinger Bands were developed primarily for stocks in a slower moving pace market. But Bollinger Bands has been adapted and adjusted and works. It's one of the few indicators that has moved over and been able to work exceptionally well in short-term trades in all the markets. It's great in equities, Forex, commodities, and futures. Bollinger Bands can be used in almost every time frame, from very short-term periods. And this is one of the things you have to keep in mind. There's lots of indicators you'll read about out there. There's lots of gurus pushing indicators. But you have to be careful for what time frames they're talking about. Because when you're trading CFDs, you're trading in short-term time periods. And many indicators and oscillators do not adjust correctly when you're trying to look at 5-minute, 10-minute, 15-minute charts. Bollinger Bands is one that works extremely well. And Bollinger Bands answers a basic question. Is the current price at this moment on a high or low relative basis? Okay. By definition, prices are high near the upper band and prices are low near the lower band. Okay. Now, we haven't gotten on to take a look at what the bands are, but I'm going to show you in a second in a live chart. So keep in mind, Bollinger Bands are a technical analysis tool. Specifically, they are a type of trading band or envelope. Trading bands and envelopes serve the same purpose. They provide relative definition of high and low that can be used to create a rigorous trading approaches and pattern recognition and much more. Bands are usually thought of employing a measure of central tenacity as a base, such as a moving average. So Bollinger Bands starts out with using a simple moving average. Okay, so let me see, hold on. Oh, wow, actually did this all right. So let me pop up a live chart here on your screen. Well, we got there, no problem at all. Got my mouse back and forth, got the screens in the right place. No, you know how hard it is when you work for so many years in a completely standardized setup, and all of a sudden, and when you use your laptop and the second screen, you don't have them next to each other, the mouse goes God knows where. And I didn't have time to change the settings for everything. So again, I'm asking you just to bear with me. So we're looking at the current chart for the Euro US dollar. We're looking at it in a 1 hour chart. And again, I'm not making any recommendation on the euro, although I see it climb back to the 118s. It was really, the dollar had kicked the hell out of it. But we're not making any recommendations on the euro tonight. We're simply using it as a teaching tool. Now, this brown band that's going through center price is the 20-period moving average. Now, we all know what a moving average is. Simple moving average is In this case, we're looking at a 1 hour chart. We take the close of the last 21 hours, 21 hourly closes, add them together and divide by 20 and put a dot on the chart. And we connect those dots to lines, and that gives us our last, that gives us our simple moving average. This is the beginning of Bollinger Bands. But a moving average doesn't tell us much. It gives us some direction to the market. There's all types of basic trading strategies using moving averages. You know, we have the red light, green light, where you only would trade a buy above a moving average. You'd only sell below a moving average. You have moving average crossover strategies. All these, which are really basic strategies. But this is just the first step for Bollinger Bands. From here, we go on and we add, let's see, I don't think I can do this back to back. So we're going to do it this way. From here, we go on and we add a mathematical calculation that's called standard deviation. Now, standard deviation is a complex mathematical formula. Come on. Oh no, I didn't want to do that. Let's see, hold on a second, let me. Oh no. Okay, we'll survive. I lost all my support and resistance lines. Okay, so standard deviation is a complex mathematical formula. And we're going to talk tonight about what this mathematical formula is. You'll never have to calculate. First of all, you can't calculate it by hand, but you never have to calculate it. But you need to understand what it is and where it comes from. Now, standard deviation, hold on, let's see if I can get this back right. Getting better. Now, standard deviation is a measure of the dispersion of a set of data from its mean. Now, that's a very complex sentence, and I have a degree in mathematics, and I'd have to sit back very carefully and chunk that together. It is calculated as the square root of variance by determining the variation between each data point relative to the mean. If the data points are further from the mean, there's a higher deviation within that set. So let's make this a little bit more easy to understand. Or let's try to put it in something that we can understand that's related to finance. Standard deviation is the measure of the spread between the open, the high, the low, and the close, and its moving average. It is calculated as the square root of the variance or the difference between the open, the high, the low, and the close by determining the variation between each of those points relative to the mean. So what we're going to do is we're going to calculate, we're not going to the computer, the variation between the moving average on the chart at that 1 hour, and what's the variation between it and the open, it and the close, it and the high, and the moving average and the low. Now, let's talk about that. If the data points are further from the mean, there's a higher deviation. So in other words, if the moving average was here and the variation to the high was way up here and the variation to the low was way down there, and the open was way far away from that moving average and the low was way far over, say for instance, we have this big peg up to the high, which is way far away from that moving average. What is it telling us? There is a big deviation from the data set. That's telling us that the price was all over the place in that period. And this gives us a visual representation because it takes into account, and a lot of indicators only take into account the close or the open. Some take in the difference between the open and the close. But this takes in the variation between the open, the high, the low, and the close. It's looking at how much the price moved from where the average trade was going to be, and how much higher it pushed, how much lower it pushed. So it gives us a lot of valuable information. So in finance, standard deviation is a statistical measure. When applied to the investment, it sheds light on the historical volatility. In its simplest form, the mean is simply the average of all data points in a given set. In investing, for example, you might want to know what the mean closing price for the last 20 days is. What's the mean closing price for the last 20 days? It's a 20-day moving average. And this can be obtained by adding the closing price of each session and dividing by 20. Now, because markets are fickle at best, traders and analysts use moving averages to adjust daily to incorporate the most up-to-date data. This means the calculation is always taking into account the most recent session's movements and the older sessions drop off. So let's get my chart back up here. Oh, got it right again. By the time this class is over, I'll have all of this down moving in the right directions. Okay, so let's see if we've got the mouse back up. So now we have the brown 20 period moving average. Now I've already dropped the Bollinger Band indicator on the chart. You'll never have to do any of these calculations. You just click on indicators, click on Bollinger Bands, and it's going to drop it on there for you. So I've closed everything down except for the basis. The basis is the 20 period moving average. Now we have the standard deviation above and below, which is the same number just in negative and positive. And this creates the Bollinger Band. Now, the overall look of the Bollinger Band, sometimes it looks like a squiggly snake, sometimes it looks like a dragon, sometimes it looks like a space alien. Has no meaning to us. Now, the overall look at the Bollinger Band, when we look at the bands, the only thing that tells us here when we see it very wide is the wider the bands, the higher the market volatility. The more contract the bands are, the lower the market volatility. So that's the first thing we can see how volatile the markets are. So we can tell right here, the market was very volatile today. Look at that. We had this huge climb up there. Now you can have a downtrend without having a volatile market. So it's important to know that price went up, but the market was quite volatile in that move. Now we always want to keep our eyes on the center band. So keeping in mind that the upper and the lower band are the exact reverse. One's 2 standard deviations above and one's 2 standard deviations below. Now, what do we have? We have the standard deviation, which is the average of the mean set. Since we're using 2 and Bollinger Bands is set on 2, it is 2 times whatever that distance was. The relationship between the price, so in other words, the candle, and the upper or the lower band is what becomes important for Bollinger Bands. It is here here. This is called riding the bands, when the price stays hugged to the bands. It's the relationship to the price and the upper and the lower band the relationship to price and the moving average, and the pushes to the band or the rejections band. When price is moving up, it should be moving with the band. And when price moves and gets rejected by the band, like here, we have a reversal. We don't know if that uptrend has ended until it breaks that moving average. So in other words, here, we're not riding the bands, but now we had the break above the moving average. So this downtrend could be thought of being over. But price again tried to push to the upper band and couldn't sustain it, came back down, fell below the moving average, and moved now into a downtrend. Here it rode the bands down, then got rejected by the bands and broke above the moving average. And at this point, we now know we are moving into an uptrend. Now, the fact is, what happened here? What happened here has no value to you here. Because the only thing we can do is trade at the window, which is here. So the only way we can trade successfully is to be able to project where price is going in the future, not in the past. Ooh, come on, mouse. So we can trade this way only. So this and this doesn't help us much, but this and this help us in being able to predict what should be coming next. Because if we know the rules of the bands and we believe in these patterns enough and we believe in what's going to happen, we can see here, look, we have it riding the band. Pricing got here right on the band, and then it got rejected. Now it is way above the moving average, but if you were in the market at this point, we might consider getting out. We would wait to enter the market. It's too late to enter this uptrend. And if we were looking to exit the market, we would be looking to exit before it matched up to the moving average. But whenever you see price riding the band and gets a rejection, you at least know that that trend is in trouble for some reason, some, why, how, or whatever. Now, there's other ways to use the band, and we're going to go back and talk about those. Let's see what if I can get. There we do. Nope. Because bands actually give us 3 different scenarios. Now, by default, Bollinger Bands is always set at 2 standard deviations and a 20-period moving average. Now, again, there's all kinds of gurus out there in the market trying to teach you other types of specialized, customized things. You can use a 2.5, and like some of my assets, I do use a 2.5 standard deviation. It's very easy to do. You just go into your settings and you change it from a 2 to a 2.5. Only certain assets, especially like say cryptocurrency, Bitcoin, that are very volatile, moving all over the place, I want to change my bandwidth so that I have more volatility included in there instead of it constantly breaking out. So we've talked about standard deviation. You understand to what it is. Now, there's also something called Bollinger Bands, Bollinger Bands percent, or yes. And it is the width of those Bollinger Bands measured between the the upper band and lower band, and then they're plotted on a chart below. And this gives us the percent Bollinger Band or the Bollinger Band percent. I don't actually use it. I just visually look at the overall spread of the bands. But remember, we start with the bands. We have the base band, which is a 20-period base, a 20-period moving average. The upper band spread above the moving average by a volatility measure called standard deviation. And the default is set at 2 standard deviations. And the lower band set at minus 2 standard deviations. So what do we have? We have the lower band, the upper band, and the middle band. Now we can use Bollinger Bands for 3 different purposes. We get pattern recognition, we get reversal signals, and we get trend analysis. Now there are many ways to use Bollinger Bands, but it's important to note that when the price touches the upper band, that doesn't automatically mean sell. Similarly, if the price touches the lower band, that doesn't necessarily mean buy. In fact, take it from John Bollinger and Sanders, says there is absolutely nothing about a tag of a band that in itself is a signal. So prices can walk the band during strong downtrends or uptrends. This means that there is a repeated instance of price touching or breaking through the upper or the lower band. And that's why you may not want to take action when the price touches either band and might instead prefer to wait for a double bottom or a double top. But this is why we constantly watch for the rejection of the upper or the lower band. But until it breaks the moving average, it really hasn't told you anything. Now, there's a pattern that we see that develops in a Bollinger Band, and it's the W and the M, okay, which are basically double bottoms and double tops, and they form the pattern of an M. But in a Bollinger Band, in our type of market, this takes too long to develop and show itself. Because as you can see here, this is a W. We don't even see this developing until it makes the second bottom or the third leg of the W. And then when it bounces off equal to the first bottom, okay, until it breaks that moving average, we haven't seen anything. And it takes such a long time for our type of fast-paced moving market. It really doesn't work so well. But if you're dealing with swing trades or slower trades or 1 hour or more price charts, you get some valuable information. So what we see is price moving down, and it forms a bottom. It gets rejected by the band. Comes up, breaks the moving average, and makes a top. We don't care where this top is. At this point, we don't even know it's a top. But then it comes back down and gets rejected at the same level as the prior rejection. And then it bounces off of there. When it breaks that moving average, it's now confirmed that it's going to complete that W formation. So if any of you guys have ever traded head and shoulders, this is the head and shoulders version of Bollinger Bands. So the classic M top is formed by a push to a high followed by a sell-off reaction and then a test of the previous high. The second high can be higher or lower than the first high. Watching the price behave like this, a trader may wonder if the stock is in a new uptrend or if it's met resistance. The Bollinger Bands might help you answer this. And then we have the reverse, and everything in our trading has upside down and right side up. So we have the M formation, which is the exact opposite of the W formation. You wouldn't see this until we get what we call the M, the N. Come on, Mousy.